You want to make a lot of money in the stock market? Very simple. Buy low, sell high. Everyone knows it. No one does it. Okay. That's why GLP-1s are so popular. And that's why all this social media is so popular. No one wants to do it. The time to buy these was not when they were in the headlines. It was when doors were falling off of Boeing's plane and you couldn't give the stock away and everyone forgot that it was a duopoly. Once the trapdoor opens, the biggest proponents of them, they disappear.
Are we witnessing the beginning of a massive dump of U.S. assets worldwide? We're going to find out what's next with our next guest, Thomas Hayes, managing member of Great Hill Capital. This video is sponsored by Kalshi. It's a fully regulated platform that lets you trade on real-world events, from economic data to political outcomes. Sign up and use my code LIN, L-I-N, link in the description down below, or scan the QR code here, and new users will get $10 when you deposit $100. Traders can put money down on their favorite teams, events, elections, and more in all 50 states, including California and Texas, and over 140 countries. More on that later. Thomas, welcome back to the show. Good to see you.
Thanks for having me, David. Glad to be here.
Before we get your asset allocation strategy for the year, so happy New Year, by the way. I know it's already third week of January, but the first time I had you on since beginning of the year. Before I get to that, I want to talk about something that's on people's minds, which is the risk of U.S. Treasuries being dumped by Europeans. So this is not happening en masse, obviously, not yet. And we could extend this conversation to all assets, not just U.S. Treasuries, but just coming in yesterday, Danish pension funds sold $100 million in Treasuries. Academic or pension said it's exiting U.S. Treasuries because of finance concerns, not because of what Trump has said about Greenland. The president with the chief investment officer said the decision was based on what it sees as poor U.S. government finances amid what they call America's debt crisis, but it also comes as tensions escalate between the U.S. and Denmark. It is not directly related to the ongoing rift between the U.S. and Europe, but of course that didn't make it more difficult to make the decision. Okay, so maybe this is just an isolated incident, and of course $100 million in treasuries is a drop in the bucket, but what's your take on this risk?
I think this guy's a clown without a circus. I mean, $100 million is like shooting a BB gun at a tank coming head on. The U.S. Treasuries is the water in the global plumbing system of the financial system. $100 million is a joke. China was a bigger threat in terms of doing that. Japan was a bigger threat in terms of doing that. The fact of the matter is, if they're sending products to the U.S., they're buying treasuries over time, and it's the safe haven that everyone goes to when there's uncertainty and when they need a secure government backstop and a rule of law. So, yes, we run risk over time if our finances aren't in better order. I will say that we had the lowest deficit in 3 years as a result of tariffs last year, close to $300 billion collected. So things are on the right track. We'll see what happens with the Supreme Court ruling on the tariffs and whether he'll have to use 4 sections in the code to work around and dividend out the current cash. Or it will remain status quo. But as far as little Denmark dumping $100 million in treasuries, it's actually a weak move from their standpoint, and it probably prompts Trump to be more aggressive with the Greenland negotiations.
Interesting. And what are the wider European investor response, if any, Thomas?
They can't afford to do it. Mm-hmm. They can't afford to do it. So I think that everyone's saying, "Oh, this what are they going to go into? What debt are they going to buy? They're going to buy pigs debt, like we had the European financial crisis. They can't issue a unified bond, so they could buy their own debt. They can buy Chinese bonds. They're going to buy JGBs when their yields are blowing out and the carry trade has been unwinding for 12 months. They're going to buy gold at record high levels. I mean, at the end of the day, historically, if you'd bought gold when all the central banks are buying gold, you had a problem and you were the bag holder. So we'll find out if this time's different, but everyone chasing gold at these levels, including central banks, we'll see how that works out.
Well, there seems to be this shifting in alliances. So Carney, Prime Minister of Canada, Mark Carney, recently visited Beijing, made a deal with China. 49,000 Chinese EVs are to be imported to Canada at a 6.1% tariff rate, which is much lower than before, in exchange for canola oil and other products. My point is, Thomas, do headlines like that make you change your investment strategy at all? Meaning shifting sectors, shifting geographies even, see new opportunities come up with other stocks or assets that previously you weren't interested in?
The number one thing that changes our view on how we're going to allocate into what companies is, does the headline in the news impact the ability of each company we own to generate free cash flow? And 99.9% of the time, the answer is no. So the folks that are chasing the most recent geopolitical headline, thinking they have some edge based on what just got reported, which is yesterday's news, are throwing darts at a board. And sooner or later, the casino always wins and the drinks are not free. Pro tip. So what we try to do is underwrite company by company. Number one, would we buy the entire company with 100% of our net worth if JP Morgan was going to finance us to buy the business? Okay. If the answer is we would not risk 100% of our net worth to be the equity to buy the entire company, we wouldn't buy one share. Number two is the price at a level where if I walked into the board of directors and offered to buy the entire company, they would be insulted and call security to escort me out the building. If they would not call security and they would entertain the offer to buy the entire company at the dislocated price that it is in the market, we won't do the deal. It's not dislocated enough relative to intrinsic value. So we use the public markets and the emotional responses, the short-term voting machine based on emotions, to take advantage and buy when people are puking due to one headline or another headline that has nothing to do with free cash flow generation, that has to do with short-term price movements, and that's how we benefit, and that's basically our edge. So we use headlines to buy great assets from forced sellers or emotional sellers in the short term, where the fundamentals will be unaffected in the long term by the latest noise.
Okay, well, there seems to be some noise in the bond market. Let's just get your comment on this. So just earlier this week, the Japanese long end of the curve rose to, I think, record highs. Coincidentally, the US 30-year also jumped about 8 basis points. I'm not sure if that's related. I'll get your comment. But here's a comment from Reuters. The Japan fiscal pressures are concerning, but markets have become more sanguine about U.S. deficits, wrote the head of U.S. rate strategy at TD Securities. So here's a chart showing the Japanese 30-year versus other countries. Can you just comment on what happened here and whether or not this has any impact on investors outside Japan?
Yeah, this is actually not news. This is something we alerted to on our podcast, Hedge Fund Tips with Tom Hayes. We talked about it going into 2025, that Mag7 would underperform as the carry trade unwound. And the number one thing that people should keep their eyes on is the yield of the 10-year JGB, which was starting to go higher, and that trend has persisted. The fact that people are paying attention to it, 12 months later, when it's just gone up effectively every single month and now is having an acute impact on people that actually borrowed money for free and were loading into the Mag7, and that's where the trade was crowded. That's part of the reason for the Mag7 trade unwind and why 5 components underperformed the S&P last year, 5 of the Mag7. That theme will persist this year because that free money is not going to be finding its way into the Mag7. So what we're going to find this year is a situation where everything else starts to dramatically outperform. You've got a case of the second reason Mag7 is underperforming is because of the earnings deceleration. So you went from 33% earnings growth, a 33 times multiple just over a year ago. In the next couple of quarters, you're going to see earnings growth down to low double digits for Mag7, and that's largely a function of capex as a percentage of operating cash flow is now 60%, which is the equivalent of oil. The oil industry, they're now having the same capex rates as the oil industry, and the multiple was still elevated above 30, so that's now compressing. as the earnings growth decelerates, and the rest of the 500 components, the 493, were at negative earnings growth a year ago, which is why they were in the gutter, and now they're moving towards double-digit earnings growth, and the multiple is still meaningfully less, at least 40% less than the Mag7. So fortunes are going to be made in the market this year, even if the indices are only up modestly. And if we look at midterm election years, there's a strong case for modestly, because going back to 1950, S&P is up on average 4.6% in a midterm election year. Nasdaq's down 0.5% in a midterm election year, going back, 7 some odd decades. So the other thing that happens in midterm election years is you have an average drawdown of 18.3%. I don't think we're going to get that pronounced of a drawdown or average drawdown this year, because you do have a level of fiscal stimulus coming through in the form of tax returns jumping 50%, 50 some odd $billion going in consumers' pockets, and you are in an easing cycle. Just as tightening works on a lag basis, so does easing work on a lag basis. So there are a lot of favorable tailwinds. You still have earnings growth in the S&P 500. I just think you're going to see a stalling or a slight contraction in the multiple, and largely led because the weighting of the S&P is still in Mag7. They're going to underperform, which will weigh on the indices. People will be they will be underwhelmed if they're passively invested in index this year with their returns, but making tremendous amounts of money if they're picking on a stock by stock basis and doing their work.
Speaking of politics, this is the U.S. Supreme Court versus Trump. The Supreme Court left unresolved Tuesday a high stakes challenge to President Trump's use of an emergency law to impose sweeping tariffs. This is from Kalshi, a prediction market. Will the Supreme Court rule in favor of Trump's tariffs? 34% of traders are voting a yes. So the question is, if they do vote, well, first of all, 34% is a minority. So let's say they vote no. Do you immediately shift your allocation to export-oriented sectors or companies?
If they vote against Trump tariffs, it's absolutely meaningless. In the short term, the market will sell off. That will be a buying opportunity across the board. In the intermediate term, he'll use the other 4 sections of the code to institute the exact same tariffs. The question is, in terms of refunds to companies, because they are selling their refund claims at 30 cents on the dollar to hedge funds. So basically, I could buy a claim that Costco has overpaid $100 million of tariffs. I can buy that for 30. If the Supreme Court rules that the Trumps are invalid and the government has to refund that in the short term, and that's the way it goes, the 30 million turns into 100. The question is, does Costco sell that at 30 cents? So in the short term, it could have an impact on the budget deficit if we have to pay out all that money. I will say Trump's not going to return the money to the foreign entities that were taxed. In the case of the consumer, he'll dividend it out to the taxpayer, which will be bullish for discretionary in the short term. It'll be a one-time bump. But my guess is there will be some nuanced solution where potentially no one gets paid out from Kalshi. Some compromise where maybe limits going forward. I don't know. But at the end of the day, if you get the surprise and they're ruled invalid, some groups are going to rally, the ones that have been impacted. The general stock market could sell off, or certainly maybe the bond market, because it would have an impact on the budget deficit. So maybe yields spike up for a day or two. But at the end of the day, let's go back to, how does it impact the free cash flow? And a lot of the companies that we're in have already made adjustments to account for the impacts of tariffs. So if they wind up having less tariffs, that's bullish. If it's the status quo, it's already priced in. So, the downside's kind of protected in terms of the business fundamentals. The upside is unlimited if they get a positive return. So again, this is more noise that keep people from making money by doing real work and underwriting business. It's so funny, David, I talk to people, and it doesn't matter how wealthy they are, whether they're a few $100 million or they made $1 billion as an entrepreneur, they still chase shiny objects. And if I sit down with them and they say, I want to buy this stock. Oh, why do you want to buy this stock? Well, it's in the news. The thing went up. That they don't say that, but that's why they want to buy it. And it's going up and it's in the news. And, it's like losing weight. You go into your doctor. It's very simple. Eat less, exercise more. You want to make a lot of money in the stock market? Very simple. Buy low, sell high. Everyone knows it. No one does it. Okay. That's why GLP-1s are so popular. And that's why all this social media is so popular. No one wants to do it. But if you ask the successful entrepreneur, okay, you're interested in buying PayPal. Okay. Well, underwrite it the same way you would buy a competitor in your real business. Okay. So in their real business, they would say, if they were going to grow by acquisition, they would say, what's the free cash flow of the business? What's the revenue? What are the growth prospects? What value add can happen? What are the catalysts for change? And what multiple am I willing to pay? And they do a sensible deal on the basis of that. And alternatively, in the stock market, somehow, because it's a piece of paper moving on a screen, they don't do the same analysis that they would do that made them successful in business in determining whether they should buy a company. And if more people just did that because they know what to do, they just don't do it, they'd have extraordinary amounts of success in the markets, whether they're professional or not. And that's kind of what we try to help people with on the podcast. It's just explaining a framework that's sensible, that's repeatable, that's not chasing shiny objects. And then all of a sudden the trap door opens and they say, what happened? The thing about these trapdoor stocks is that once the trapdoor opens, the biggest proponents of them, they disappear. I don't know if you've ever noticed that. They go quiet for 3 months, after their stock drops 60%. And it's because really smart people aren't doing the normal underwriting that they would do in the real world, whether they're buying an apartment building, whether they're buying a business. It's not rocket science, what you have to do to make sensible investment decisions.
Are defense stocks a trapdoor then, Thomas? This is Lockheed Martin. It's up about 30% since early December. So a few factors at play. Of course, Trump is proposing a raise to the defense budget of $1.5 trillion. And of course, there's geopolitical tensions heating up left, right, and center pretty much across the globe as we speak. So what's your take on defense stocks?
It depends. I mean, we've been owners of Boeing for a while. That was a $135 stock in April. You couldn't give it away. Now it's $250. Everyone's getting interested. I'm not worried about the short-term news that made defense stocks as a group go up, because when I bought it at $135, I underwrote it for $300 based on free cash flow and deliveries over the next 5 years. So should I get out just because it had a move in the last 3 weeks based on headlines? No, it hasn't. It hasn't reached my full target of intrinsic value. So therefore, the short-term headline doesn't matter. Now, am I chasing Lockheed Martin after whatever 30% move in a few weeks? Of course not. That would be probably a mistake. It'll take a breather after the geopolitical fear comes out. But the time to buy these was not when they were in the headlines. It was when doors were falling off of Boeing's plane and you couldn't give the stock away and everyone forgot that it was a duopoly. And, as pissed off as Southwest was, they could go to Airbus and wait 25 years for the next plane, or they could suck it up and wait for Boeing to get their act together and continue with their orders. And that's exactly what they did. So the short-term headlines are the things that make you lose money. You have to. What we're trying to do, David, is we're trying to find and buy not great businesses. We're trying to buy good businesses at great prices when no one wants them. And then when the headlines are favorable and everyone wants them, we lay it off. So for instance, Albemarle, okay? You couldn't give the stock away at $58 10 months ago. Everyone said there's a huge glut of lithium. You're never going to be able to do this, blah, blah, blah. So at $58 and $60, we were buying it hand over fist. And now at 165, we've sold out a bunch of it. It's gone up to 178. It probably goes a little bit higher, but it's not going to go up at the same pace. A triple in 10 months is pretty aggressive IRR. So these are kind of the common sense things. So the answer to your question, David, is like, should I chase defense stocks? They're going to go up over time, but they've probably gone up too much in the short term. And if they're in the news, I'm not really interested in being involved. I'm more interested in things that no one wants, like oil servicers. No one wanted at the beginning of this year. Everyone said oil was going into the 40s. Now you have some geopolitical noise. People are getting interested in energy. Hedge funds are selling record WTI in the hole. Commercials have been buyers. So we know it's going up because hedge funds always sell in the hole and commercials are always early and they're always right. And energy stocks as a percentage of the S&P 500 are at their lowest weighting since COVID in 2020 when oil went negative. And prior to that, 2000 during the tech wreck when no one wanted them. And if you had bought energy stocks in those periods, whether it was $33 during COVID for ExxonMobil or others, you made fortunes. And we think there's another opportunity, particularly as it relates to the servicers. And that's an area that no one wants to give away. The other area that you couldn't give away in September, which I think we talked about with you last, was healthcare. We said that was going to be a huge performer in 2026. It had a rally into year end. There's still a lot of juice in that because healthcare outperforms in midterm election years. 9% returns versus the S&P of 4.6 versus the NASDAQ a negative 0.5. So that's kind of where we've been focused, is in those areas that no one wanted. Same with small caps. So small caps over large caps, international over US, because the weak dollar is going to be a theme for the next 2 years. Cyclicals over real world economy, businesses over tech. That's worked. And just skating to where the puck's going, not where it already is kind of the theme. And I think a lot of your viewers know that. The key is to, have the discipline to eat less and exercise more. Buy low, sell high.
So what about, are we buying low and selling high on the Russell? So it's been underperforming the S&P for years now, except the last 6 months. Last few months, to be precise.
That was another theme of ours for this year and for last year. Last year it didn't work as well as this year until the second half of the year. That theme is going to persist. These are multi-year themes. Same thing happened in the early 2000s. You're going into an easing cycle. They're going to be able to refinance their debt. The real world economy, the Main Street, the policies. You heard Besant on talking about 4 to 5% real growth this year, 7 to 8% nominal growth this year. Those are the environments that real businesses, cyclicals, industrials, energy, financials, they outperform, not the Mag7 kind of defensive plays that were effectively carry trade money parking for the last 5 years. That gig is up. All you have to do is watch Chinese bond yields. If they go, Japanese bond yields. If they go down, Mag7 will get bid. If they keep going up, Mag7 is going to underperform, and their earnings profile is the second piece to that equation.
Speaking of Mag7, perfect segue. 5 of the Mag7 underperformed the S&P 500 in 2025, 2026. This is a chart that you've shared. So take a look at this story, by the way. This is coming out of Davos, so pretty live news as we speak. This is the Microsoft chief CEO Satya Nadella. He's warning of an AI bubble, and he's not the first person in big tech to have made messages like this. The Google CEO also said something similar last year, but he said, for this not to be a bubble by definition, it requires that the benefits of this are much more evenly spread. He noted that a telltale sign of a bubble is that it would be only tech groups benefiting from the rise of AI rather than companies in other sectors. He was confident that AI would prove to be transformative across industries, including developing new drugs. Okay, so can you just take this warning and evaluate it, whether or not we are seeing AI just being used by, or I guess developed and CapEx being sent back and forth by big tech companies to other big tech companies, and actually dispersion amongst other sectors outside tech is relatively low? Is that true?
He's 100% right. And a key theme we have at Great Hill Capital is AI beneficiaries versus AI cost centers. We've avoided the cost centers. That has been correct. We have invested aggressively to the beneficiaries. That has been correct. I think part of the reason Mag7 is underperforming is there is no evidence of return on invested capital today. That's going to take a year to 2 years. And sometime between now and then, you're going to have an opportunity to buy these businesses at better prices, much better prices. We think probably towards the fall of this year, if the normal midterm election year cycle is correct, we're strong through April, very weak into the election, recover at year end. So if they're very weak into election, I think you're going to have a chance to buy some great Mag7 companies. They'll look very pessimistic. They wasted all this money, no return. That return will come. I don't think we're at the end of the AI cycle. I think we're in the middle innings, and this is going to be probably an aggressive hiccup. At the same time, you're going to see the regular businesses, the 493, improving margins, increasing. One of the companies we came to talk about that we own is Stanley Black and Decker. They have recovered margins to 33%. They're going to be, they've taken $2 billion of costs out of the business. They're going to be back to their peak 35% margins within probably the next 12 months. The last time they were at 35% margins, and this is, by the way, a business that was started in 1943. They're the leader in tools and engineered fastening systems. Okay, it couldn't get any boring. Partially a housing play, but the last time they had 35% margins, they earned $8 a share, and it was a $150 stock. It's an $80 stock right now. So these are the type of companies that are going to take costs out, increasing margins, and be the beneficiaries. And then people are going to start to say, okay, these tools are valuable. We're seeing them in action. And then these type of companies are going to be paying the hyperscalers and the Mag7, and we're going to start to see the return on investment 2 years out for all the investment that they've made. And that's when they start to recover. But that's going to be a 12 to 24-month process. So right now, you want to be in the ones that are just starting to benefit from it, not the ones incurring the cost, but the ones reaping the benefit. Unmagnificent 493, they're going to be the ones that outperform in the next 12, 18 plus months. And these guys will probably struggle for a little while, continue to make investments, and then they'll recover, some year, a year and a half to 2 years down the road, and probably the next leg in the theme for many years. And that's kind of how we're positioning around it. So now that's a whole complicated way to say their earnings growth is decelerating because their CapEx has gone up. Okay. And they're not getting a return on that CapEx yet. So we're taking the view they won't get a return on that CapEx for some time. So we want to avoid them. And we want to be in those that are getting a return on implementation of these type of strategies and improvement of margins. And that's by and large all the ones that are the beneficiaries versus the cost centers.
One more equity sector I want to just bring your attention to. So home builders, Home Depot up 11% since basically beginning of the year. Stanley Black and Decker, SWK, up 30-something% since mid-November. And yeah, it looks like home building stocks and equipment renovation companies, I'm just using two as an example, doing pretty well start of the year. Is this a leading indicator for housing?
Is it the leading indicator for housing? Are you talking about home builders, or are you talking about the sector?
Let's just take Home Depot. Let's say the stock goes up. Does that signal to you that people are, I guess, either planning to either renovate their homes or sell their homes, or one or the other, new activity in the real estate sectors?
We're in an easing cycle. And if you're not owning housing in an easing cycle, you're going to miss the gravy train. Now, I would be buying everything excluding home builders, because supply is going to increase. And but that doesn't mean their margins are going to increase. I think it's going to be a race to the bottom in terms of margins for home builders, because you're going to get a lot of supply on at the same time as rates come down. There's also going to be existing inventory that comes on the market that hasn't been on the market. We actually think affordability is going to happen. We think this is going to be a situation that is the opposite of what everyone thinks. What normal happens, rates come down, prices go up, trades like a bond. This time, I think rates come down. I think you're going to see a glut of supply hit the market all at once. You got so much trapped equity in baby boomers who've been waiting for the window. And the minute that supply starts to hit, you're already seeing it in Florida and in Texas, and the comps hit negative, everyone races to the window. They say, holy cow, that just traded 4% below ask. I better get out while the getting's good. And then everyone lists all at once. So I think affordability is coming to a theater near you. That said, supply is also coming to a theater near you. And we're playing this theme very aggressively with Stanley Black and Decker, with QXO, which is Brad Jacobs' company, home building supply roll-up. He started with Beacon Roofing Supply. He's a proven moneymaker. If you'd invested $1 million with him in United Rentals when he did that roll up, you made 200 million. If you invested $1 million when he did XPO, which was the logistics roll up, you made 50 million. So this is his new play. We like that. And then Generac, the leader in home standby generators. They also, by the way, have a $500 million backlog for data center generators. So these are ways to benefit from the housing recovery, to your point, but not get stuck in the home builders where I think margins are going to be compressed, even though they're putting more supply on the market.
All right, great analysis. Great talk. Thank you, Thomas. Where can we find you?
On X, my handle is at Hedge Fund Tips. We got a big following on TikTok at Official Hedge Fund Tips. Nice. The podcast is top in the hedge fund category. It's called Hedge Fund Tips with Tom Hayes. You can find it on YouTube or anywhere you get your podcasts. People have found that really helpful over the last 6 years. And then, your normal TV stuff, Fox Business, Yahoo Finance, and all the rest. So I appreciate you having me on today, David.
Well, appreciate you coming on. Just give us a teaser on what you're working on over there at Hedge Fund Tips, just so people can look forward to following you.
Well, each week we put out an article covering 2 of our holdings and our core thesis and updates to that thesis. That's at hedgefundtips.com. And then each Thursday, we do our weekly video cast and podcast. We're going to cover a lot of economic data this week. We'll probably put a lot of this clip into the podcast so a lot of people can be introduced to the David Lynn Show. And you're going to be extremely excited about what we're covering. This week is Energy Week. We're going to be covering an update on National Oil Well Varco, which is one of our servicers that'll benefit from the Venezuela situation, as well as Comstock Resources, which we've had for some time, from $8 and $9. It's now mid-20s and going higher. Jerry Jones, the owner of the Cowboys, owns about 75% of that alongside us. And we're excited about this week's information for sure.
All right, excellent. We'll put the links down below, so make sure to follow Thomas and Hedge Fund Tips. Thanks again, and Happy New Year. We'll see you again soon.
Thank you, David.
Thanks for watching. Don't forget to like and subscribe and follow Thomas and Hedge Fund Tips in the links down below. And don't forget to use my code LIN, L-I-N, when you sign up to Kalshi. Remember, new users get $10 when you deposit $100 on your first trade. Link down below, or scan the QR code here to get started.